Equity markets have proven very resilient to the pandemic, but also the uncertainty around the US election. But the key question now is whether that will continue into 2021. And personally, I think there are several reasons why that may not be the case. But remember, if we do see an equity sell-off, that's an opportunity. It's an opportunity to buy equity at a lower price. It's not an opportunity to sell your equity. Now, if you do want a source of information which cuts out the noise and also educates you about investment and economics, then why not sign up for our free weekly market roundup? There'll be a link above me and in the description below me. So let's look at a potential sell-off in 2021 and the reasons for it in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's start off by talking about headwinds, which are the factors which tend to reduce equity prices. So this is based on the Senior Loan Officers Survey, which is published by the Federal Reserve. If we're up here on the positive side of the graph, then that suggests that credit conditions are tightening, and that means that it's harder for companies to get loans. And the particular time series I'm talking about here is a number of banks tightening credit standards for commercial and industrial loans to small firms. And a negative number, which is down here, means that credit conditions are easing. That tends to be good for the equity market. And now I've superimposed the annual gain in the S&P 500 onto the same graph. Now where I am here is a period of very easy credit conditions. It was easy for companies to get loans. And it's not a coincidence that that was also a period when equity markets performed very well. Whereas just after the year 2000, which is when the dot-com bubble burst, there was a very significant tightening of credit conditions. But notice how there was an overlap period where for several quarters, and each of these blocks represents one quarter, because a Sluice survey is published quarterly, there was about a 3-quarter period when equity markets were still rising, but credit conditions were tightening. But after 4 quarters of tightening, we saw a very big sell-off. Then we saw a period of easing when equity markets did well, and we all know that during the global financial crisis, credit conditions tightened a lot and equity markets sold off a lot. And since then, we've had very easy credit conditions and really very good equity returns. But what I'd like you to focus on here is this very big credit tightening that we've just had over the last 2 quarters. That's for obvious reasons, because in a recession, banks don't want to make losses on loans, so they tend to tighten up on their credit conditions. So now let's zoom in on the most recent data on this graph. So this now starts in 2018 and comes up to the most recent data in November 2020. And what you can see is 2 quarters of tightening, which pretty much take us to the same levels that we saw in the global financial crisis. However, what we haven't really seen, although we did have a short, sharp equity sell-off in March in 2020, but equity markets have been very sanguine about those tightening credit conditions since then. But I think this is a key indicator to watch. If credit conditions continue tightening, that could be a real problem for some companies. And it's always worthwhile looking at earnings growth for the S&P 500 because that's the engine which fuels price increases. Sometimes markets get ahead of themselves and people pay too much for earnings, but it always snaps back to the long-term average. That average may be slightly higher if rates are low, but it's still mean reverting. So in blue here, you can see past S&P 500 quarterly earnings based on data from FactSet. And in red, you can see the forecast earnings based on bottom-up forecasts from brokers. But what's really remarkable is that earnings for the S&P 500 just stopped growing in Q2 2018. And that followed a period of very rapid growth, which may have been due to the corporate tax cuts from President Trump. And the previous earnings peak was about $42 in Q4 of 2019. And since then, we've seen corporate earnings plummet. Now that's what we call an earnings recession, when earnings are falling year on year. And we won't get back to the previous peak, according to forecast earnings, until Q3 in 2021. To summarize that on this timeline, this period of no earnings growth has lasted for almost 3 years, and yet equities have still managed to rise quite significantly over that period of time. And if we believe broker forecasts, that earnings recession should last about 2 years. So what I've done here is I've gone back to 2013 and I've decomposed the growth in the S&P 500 into two factors. The first factor is fundamentally driven, it's earnings growth. But the second factor is based on exuberance. In other words, how many dollars are people willing to pay for every dollar of earnings? So you can see that during this 2017 period, earnings were growing. So the blue bar got wider, and that was a significant driver of the price increase of the S&P 500. But during this period of no earnings growth, you can see the fundamental share explaining that price growth has shrunk. And if we look at the most recent data, it's now the case that almost all of the price growth of the S&P is due to re-rating. And this is what Robert Shiller describes as irrational exuberance. That means it's going to be harder for equities to justify a very strong rally during this period when earnings growth simply isn't at the levels it reached in 2019. If we split up the S&P 500 into its component stocks and look at their performance, which you can see here on the y-axis, versus the size of the company or its market capitalization down on the x-axis, there's a very clear trend, where small caps, which is where I am on the graph, tended to perform worse than large caps, which are over here on the graph. And above me you can see those 5 mega cap stocks which have been the engine of growth for the S&P 500 during 2020. So that's Amazon, Apple, Microsoft, Google and Facebook. But there's a very long tail of stocks over here on the left which have underperformed. So if the rally is going to continue in the same vein, these companies are going to have to generate very good earnings and fundamentals to keep it going. So the y-axis here beside me is the same as it was before, but on the x-axis now we've got the level of debt of a company, which I've measured using its debt to enterprise value. The trend now is a negative one, such that if you have less debt, you'd have had higher returns year to date. Now if you're wondering what this cluster of green stocks are just underneath me, those are all financials. They typically tend to have much more leverage than other non-financial companies. But it's noticeable that they too have been laggards in this rally in 2020. And that is why credit conditions are so important for the S&P 500 to continue to do okay. A large number of the companies in the S&P 500 have actually quite poor credit quality. And if tightening credit conditions choke off that availability of credit, it's going to be a real issue for a lot of companies in the S&P 500. If you're enjoying this video and you want to support our work, you can always just like the video, but you can now also join our YouTube community. There should be a button underneath this video. I've also done a video about the tech stock rally and whether it can continue, and in that video I talked about the risk of concentration in the S&P 500. And in this graph you can see that concentration peaking just before 2000, and that preceded a fairly significant equity fall. And recently those 5 large stocks make up about 1/5 of the S&P 500. And what Goldman says about that is that these narrow market breadth situations always resolve in the same way, which is that narrow rallies lead to large drawdowns. And the reason for that is that the market leaders fail to generate enough fundamental earnings to justify their elevated valuations. If we look at the Nasdaq 100, which is dominated by tech companies, the concentration situation is even more severe. This is something called the Herfindahl-Hirschman Index, which is another measure of concentration. And you can see that that's been increasing very rapidly since 2015 for the Nasdaq. And if I look at the market cap proportion in the top 5 stocks, as we saw for the S&P 500, those same 5 stocks make up about half of the Nasdaq 100. There was a slight decrease in that proportion when we got the tech sell-off in September, but it only decreased to about 49%. It was only a 1% fall in that concentration. So while the S&P 500 is heavily reliant on those 5 companies, this is even more true for the Nasdaq 100. And my final concern is based on positioning. In other words, how many people are buying risky assets like equity and how many people are buying safe assets like treasuries. Now in the futures market, you can work out that speculative positioning. And currently it's very extreme. The last time it was this extreme was in December 2008. If we zoom in on the graph from the tweet, the dark green line is how much people prefer equity over treasuries in the speculative futures market. And currently that's at a very extreme level. But this reflects the broader preference at the moment for risky assets. The S&P 500 represents a very crowded trade. And if conditions worsen, then I suspect many people will be fleeing that trade very rapidly. And the lighter green line represents the market cap to GDP ratio, which is the preferred valuation measure used by Warren Buffett, which shows that not only are people heavily positioned in equity, but valuations are actually very extreme as well. But that's true of almost any valuation measure that you look at the moment, whether it's forward price to earnings or trailing price to earnings or cyclically adjusted price to earnings. All of them show that US equity is expensive. But it's certainly not true that everything is not supportive in this market. For example, if we look at central bank policy rates, almost any central bank at the moment is very accommodative. In other words, it's trying to stimulate the economy by having very low interest rates. That means it's cheaper for households, but also companies to borrow money. It also means that debt servicing costs tend to be very low. And that's an unquestioned benefit for the equity market. In addition to very accommodative monetary policy, we've also seen lots of fiscal support measures. And in this graph, we can see the share of GDP spent by several countries expressed as a percentage of their GDP, which is the size of their economy. So the US, Japan, Germany, Brazil have all spent around 1/10 of their annual GDP in order to prop up their economy. And in the US, we may see further fiscal stimulus, which could be a big boost to the US equity market. And that could tide markets over during this difficult period of an earnings recession until earnings start to organically support the index again. And in my video about the tech rally, I also talked about these secular trends, which means a long-term trend. And the pandemic may have simply acted as a catalyst, and this just hurried along trends that we already saw, such as cloud spending, shopping online, but also working from home. And one source of support for the S&P 500 has been share buybacks. And in this graph from S&P Dow Jones indices, you can see the amount of dividends paid out for the S&P gradually increasing, but that's been outstripped by the amount of money given back to shareholders through share repurchases. Now, while that fell dramatically in Q3 2020 because revenues fell and companies didn't have enough cash to buy back their shares, eventually that will probably kick back in as revenues start to increase again. And when that happens, which of course it will happen because all recessions are temporary, that'll be a big support for the S&P yet again. So while I do think there's going to be a rough period in 2021, eventually things will get back to normal. And then earnings growth can start again, but we may have picked up some bargains along the way. If you enjoyed that video and you want to support our work, you can either do that now via YouTube, because we now have a YouTube membership and you'll find a button underneath our videos, or you can join us on Patreon. So if you want to see what benefits you get as a member, you can click on the icon on the far side of the page to learn more. And as always, thank you for listening.